Eric Mwatha here. In this educational video, we're going to be taking a look at moving averages, and we're going to be taking a look at this from a weekly standpoint. And what we're going to be trying to find out is how we can use the moving averages sometimes to tell us where the market is trying to push stocks or even ETFs or even the market itself. So what you're going to observe is that on a weekly chart, so remember we are looking at a weekly chart. This is where I have observed this taking place. So weekly, and we are using the 10-week moving average, 13-week moving average. Sometimes I use that, and you can use either the 33 or the 34-week moving averages. So you can use either or week moving average. All right. So you can use either of those. Now, let me just digress here for a second. You can see this 10-week moving average, 13 and 34. I actually believe that this is, you can use either 8, 13, 21, or 34 on the weekly. Now you'll notice all these are Fibonacci numbers, so you can use either of these numbers on your weekly charts for the moving averages. But for this purpose of this video, I'm gonna be using 10, 13 and 34, but I believe that the ideal numbers could be either of this combination here. So what we're going to observe here is that on a weekly chart, let's say the stock's been trading at a range, and you get that the moving averages, let's say the 10-week moving averages, comes and makes a fresh low. So let me try and explain this. So let's say the stock has made a low here. Stock's been trading, and while the stock is here, you see that your moving average is already trading at a fresh 52-week low. So your moving average makes a fresh 52-week low, but the stock has not made a fresh 52-week low. So what happens is that you'll notice that eventually, what you're going to notice is that the stock eventually is also going to make a fresh 52-week lows. So what I'm saying is that there are going to be instances where, let's say the stock is trading and the prices are moving higher. Let's just change it now. You find that, so this is the 10-week moving average, makes a high, comes and makes another fresh breakout high. So let's say you got a fresh breakout on the 10-week moving average, and yet your price has not made a fresh high. So let's say price is trading in this general area. Price has yet to jump to fresh 52-week high. So what I'm saying is, whenever you see the 10-week moving average, or maybe let's say you're using the 8-week moving average, whenever the moving average makes a fresh 52-week high and price has not made a fresh 52-week high, then what you're going to observe is over time, even the price is going to jump to fresh 52-week highs. In other words, it's a very interesting timing approach, because once the moving average makes the new high or the new low, then you can go in and place a bet, because the moving average is already pointing and telling you that the prices are going to follow over time. Remember, it's a weekly chart, and it's going to be giving you what the stock could do in the next couple of weeks, in the next couple of months. So it's a very good swing trading strategy if you want to hold on to a stock for a couple of weeks or for a couple of months. So let's take a look at some examples. So the first example here is for NUGT. Of course, this is the gold, 3 times gold miners ETF, very volatile, and this is after it has split a couple of times. So this is not the actual price at the time, but what I want us to take a look at is, if you take a look at the moving averages here, these moving averages are getting very close. In fact, if you take a look at the 13-week moving average, which is the red line, 13-week moving average is very close at this point here to make a fresh 52-week low. But prices haven't made a fresh 52-week low, because this is the low here on a 52-week basis. But you can see that the moving averages are very close to breaking to fresh 52-week lows. Remember, this is a weekly chart, so want to emphasize that it's a weekly chart we are looking at. This takes place on a weekly chart. Let's take a look at what happens after that. So the previous chart you can see that now the stock has moved to fresh 52-week lows, and eventually you see that price eventually did jump to fresh 52-week lows. So the previous chart, the stock was trading at about 1400 with the 10-week moving average suggesting that it could break to fresh 52-week lows, and you can see that eventually prices did jump and make a fresh 52-week low here at under $900. So after this 52-week low in a 10-week moving average, the prices eventually jumped to fresh 52-week lows. Now on this example here, take a look at the 10-week moving average and the 13-week moving average. All of them, even the 34-week moving average, all of them are pointing to fresh lows. Fresh lows here on the 10-week moving average, fresh lows on the 13-week moving average, but the price has not reflected that yet. So once you see that the moving averages are making a fresh low, then you can place a bet that more than likely, remember you're just playing the odds here, more than likely that the stock eventually is also going to make fresh 52-week lows, just as the 10-week moving average has made a fresh 52-week low. In fact, in this instance, fresh all-time low. So let's move forward here. You see that after this fresh 52-week low here, prices were trading at about 1200 or 1100 in that area. The stock would eventually go all the way to trade as low as $400. That's almost a 60% drop, just because of this observation here that the 10-week moving average was leading the price by making a fresh 52-week low, fresh all-time low. So eventually prices would really cascade after this break in the 10-week moving average. Prices followed after that. Hope that makes sense. Let's go to another example here. So a couple months ago, I told subscribers that it was very likely that the GDX would move to fresh 52-week lows. The 52-week low was here. The reason why I was saying that, as you can see here, the 10-week moving average was making a fresh 52-week low. In fact, the 13-week moving average was already trading at fresh 52-week lows. Here you can see the red line was already trading at a fresh 52-week low, and I was letting subscribers know that more than likely we might get a push in the GDX to fresh 52-week lows. So this was in September. By December, you can see that prediction happened to be correct, because now the stock is making fresh 52-week lows. So because we took advantage of that idea that the moving averages were leading the price, this has been a very nice trade for us. We've been making good money shorting this instrument by way of the 3 times bearish, the DUST. Let's take a look at another example here. Again, NUGT. This is in September. Take a look at the fact that the 10-week moving average is making a fresh 52-week low. Prices have yet to make fresh 52-week lows. Prices are very close to 52-week lows, but the idea here is that you got the 10-week moving average making a fresh 52-week low, moving to all-time lows. This was at a price of $50 here. This is September. If we move forward to December, we see that now we're not trading at $50, we are trading at $25. So that's a 50% drop, because the 10-week moving average has been leading the prices. Now let's switch gears and go to a different example here. So now this is the XLF, and as you can see, the XLF here, the 10-week moving average is making a fresh 52-week high right there. We got the 13-week moving average making a fresh 52-week high here, but notice that prices are not at 52-week highs. So you can assume here, by placing a bet, that more than likely the moving averages are suggesting that even the price is going to make a fresh 52-week high. So let's fast forward, and you see that was correct, because this was in December of 2012, and now we go to December of 2013. We can see that this was leading. The 10-week moving average made a fresh high there. The 13-week moving average made a fresh high there. Eventually, prices caught up, jumping to fresh 52-week highs, and since then, this market has been on fire. So let's take a look at another idea here, and this is the last one. This is just a live example. This is the IYR, and what I want to sensitize you here is take a look at the fact that this is very close to making a fresh 52-week low on the 10-week moving average, and also the 13-week moving average is very close, if not already trading at fresh 52-week lows. So what that suggests to me is that you need to place a bet here on the IYR. More than likely, even the prices are gonna make fresh 52-week lows in the next couple of weeks, in the next couple of months, because the moving averages are already making fresh lows. So that's the best way to play this idea. Maybe it works, maybe it doesn't, but if history repeats itself, it's a nice way to position yourself one way or the other. Eric Mwade, good luck, peace, and blessings. I am out. Woo!